I think we need to have a more honest conversation, a more open conversation about what makes for a real return on the continent. Because today the expectation is 20 to 25% growth. Yet, what we're seeing, top quartile performance, according to Cambridge, is single digits, which means very few of these investors are even hitting the hurdle. So for me, the question is, why are we having such a big gap? Coller Capital used to do some amazing work around trying to gather investor sentiment on what the risk premium is. And Africa, hands down, has got the highest risk premium. It used to hover around 17%. Yeah. So for me, and I'm curious, for you, Damien and Daniel, what you've been sort of the discussions you've been having and what your views are. Because I think until we have a more realistic conversation, because we have our issues in Africa. It's not, by the way, that everything's perfect. You know this painting behind me? That yellow can is called a jerry can. It's named after Jerry Rawlings in Ghana, because during his time, that's how you got your fuel. Right? We know we've had issues in the past. We know we still have issues. Hugely excited, but somewhere in between, that realism, I feel, needs to come in when you're having the discussion about what you as an investor are committing to your investors, right? Your LPs or whoever is putting money behind you, because the pressure you otherwise put on entrepreneurs is ridiculous.
It's unhealthy.
It's ridiculous, because a 20 to 25% return in hard currency, by my calculation, means that you're asking an entrepreneur to take $100 and give you $300 within 3 years. Bearing in mind, they're taking the hit of currency erosion. Nigeria has just gone through 2 devaluations, which means that if you put money into a Nigerian business even 2 years ago, they're going to have to grow 12 times to give you a 2 to 3 times return. So I worry about what this means, especially from an impact perspective, because there are enough entrepreneurs that are also standing up and being quite public about saying, when investors come in, we frankly feel like we are not able to keep up with those expectations, even though we're growing hand over fist. So I'm curious I know we're past the recording bit. So for me, this is just a conversation. I was curious to get your takes on, all of you.
I'll say our largest investment is into a company called Paga in Nigeria.
I know.
Good example.
I know Tayo, and Tayo's been at this for years, right? He's been at this for 10 years.
Yeah, exactly. So that and that's kind of point. We started working with Tayo at the very start. Not at the very start. You're probably like 2 years into it, or maybe 2.5 years in. On a valuation perspective with his company, it's like significant multiples in terms of, because we got in really early. But our fund has a 16-year time horizon, with optional extensions as well on top of that. And that's the only reason we could actually really invest in the types of companies that we do. Because the moment you put a normal time horizon on it, you'll cripple the companies. You won't be able to weather the storm with them. And it's horribly unhealthy for everyone. So that was I think it was one of the, just talking to other fund managers across emerging markets at that time. Anybody who pitched the fund as a traditional fund, with a 10-year time horizon, was in a lot of pain. And their investments were in a lot of pain. We got a lot of feedback. And so for us, we said 16 years with the option of another 4-year extension at the discretion of us. So we could have a 20-year fund. And that's helped at least be able to weather the storm. And Paga is a great example, because there's been 2 or 3 moments where it's just been terrifying. I think they'll make it through because they're remarkable. But had we had a normal time horizon, it would never work. Not even close. It'd be disastrous.
How much of that was due to the fact that was an early stage business and just the fundamentals of those business? For me, coming from private equity and then now more recently doing VC, but the 2 funds, the IC that I sit on in Botswana, our deal size, it's a private equity fund. The board I sit on with the conservation fund in East and Southern Africa, that's doing larger tickets. And I've never fully understood or believed the approach that has been taken with unicorns. So I'm not excited about Africa's first unicorn, because that landed flat on its face. And we had discussions about, is this even an African company? Is this a unicorn, etc. So for me, I am a fundamental investor. I like to invest in things, in companies which are providing real goods, real services that real people are actually using, right?
Yeah.
For me, that's a big part of why I invest in a company. Technology for me is an enabler. Because, as we were talking about before, if you don't have access to sufficient access to electricity, your market is really very small. And so I'm curious, Daniel, how many of the investments you make are into businesses which are actually throwing out cash, which are cash flow positive and which are able to scale? Because otherwise what you're constantly doing is sort of going into more and more rounds of fundraising, and valuations then look very interesting, but have zero correlation to the catalyzing of returns, the crystallization of returns rather than the catalyzing.
I think, primarily like our partnership with Barclays, the initiative is called Unreasonable Impact. Pretty much across the board, companies, I would say at least 80% of the companies are at the very least cash flow positive. A number are actually already profitable, and part of that's because we're aligning with a bank, and you want to see.
Yeah, we'd probably put some criteria on there. More criteria on there.
Assets, you want to see cash flow, but part of that is we've also pivoted in terms of our kind of theory of impact. Is we've gone a little bit later stage and said, instead of working with what's potentially the next new thing, i.e. Paga 8 years ago, let's align and scale what's already working. And the theory there is that we'll have more of an impact quicker if we find solutions that are already a market that are already working, and then give them kind of an unfair advantage. So you might be bringing clean drinking water to 2 million people, and it's actually profitable. Our question is, how do we help get you from 2 million to 200 million people faster? And I think that's a beautiful place for financing to play. Because oftentimes the hindrance is that they can't leverage it because they have to finance off their balance sheet or whatever it might be. So we've transitioned, because at the onset we were much earlier stage, and we saw a dearth of support kind of at the, I guess, a little bit more growth equity stage, but also it seemed like we could have more impact, and it aligns much better with Barclays and what their clients are seeking, whether it's private or investment banking. It's
it's interesting actually to your lots of thoughts there. Both in terms of the gap in the market for a program like Unreasonable that did and focused on that, I can still see that, right? In some ways, getting something off the ground and getting the grant funding and early stage and super angel, stuff is possible. And appreciating the concerns that you have around traditional VC capital coming in as well, or private equity capital, and the expectations that are put on. There's still that gap, and that's part of the reason why I thought we need to do something about it, because that exists for everybody, actually, for everybody.
Yeah.
And that's where I think Unreasonable is very cool, because a £5 million raise or a £10 million raise is massive to scale for some of these companies, but that is insanely difficult because you don't fit the existing models, and banks don't quite want to do anything, so there's a massive issue and a gap there. And I think in particular also, back to your question of Africa. So one thing is the return expectation question that you have, and Urvi probably has a better sense of this. It's not just Africa, right? Investors have overinflated expectations over a recent history of what return expectations they should have. And marketing materials of traditional VC and PE funds have only exacerbated that relative to the reality of how much they are actually delivering, right? There is definitely a gap there. But see, mentally, people think and want that expectation of return. And therefore, that's the starting point, which, to your point, is really the flow through, right? The pressure that ends up cascading down is a problem, right, on the entrepreneurs. And I think, to your point, even more so on a currency basis, right? When you're thinking about raising in hard and going to local, and then the back out of it, the fiduciary duty story of 2 LPs means that, we need to get it back out, and we promised them this, therefore, how are we going to do it? And we put stuff on, actually, it was funny, a few years ago, I got something onto our direct investment platform, really interesting fund doing middle-class housing in Southern Africa. Actually, it was probably now, I think it was about 5 or 6 years ago, and it was right when the rand just completely blew up. And so for most investors that are thinking about that transition, they're like, nah, can't do it. Even if you could tell them a 5-year, 7-year, 16-year, I mean, good luck telling most investors a 16-year story. But
yeah, totally.
but even a 5-year to say, look, now is actually a great time to be invested because of the devaluation, because yes, we don't know exactly where it's going to be, but it's probably going to be better than what it is. I mean, I don't know actually now if it is, but that concern of getting private capital into Africa, and I know Daria, absolutely committed to that, in terms of personally wanting more capital. And I think we all do, that currency challenge is an issue. And I think that it's interesting to think about, well, what are the funding structures that we know and we're using or trying to use, to your point? Ani Patton, is a researcher and academic, actually has just recently published some stuff on thinking about different models of capital going in. Not to, actually, she's South Africa based. Not the only one. I mean, the guys over the 50 Years Fund also, have, time horizon as well. I think the challenge is, and being able to bring in or access capital in a way that doesn't fit what has been done thus far, and therefore is, revenue linked as opposed to just exit option, is linked to different activity sets or impact outcomes, is backstopped by, more public funding or CDC type funding. That's the thing I think where we get more capital involved, as opposed to just going, we know VC, we should just do a VC model in Africa and everything will be fine because it worked elsewhere. Because the reality is it probably hasn't worked elsewhere as well as everybody wants to make it out to be.
Yeah.
And therefore, for me, that's where it's sort of a bit more, heretical for me to say, like, you need to change a little bit how the system itself works in order to make this work fundamentally. And I think there's indications of it working, but you need more examples of it to give people the confidence of going in a different way than what happens today. Because investors will eventually accept it. The herd mentality of investors means, well, if this is what we have an option to do, then this is what we should do. And actually, quite honestly, on the other side, just thinking about it, right? If this is the only capital that entrepreneurs can access in order to scale, then you're stuck, because you're like, well, I can't scale up with bank finance locally, and I can't scale up, with more investment from, the scale of investment I need. I have to take this, which, doesn't make sense to me either.
Yeah.
So, we're at that precipice, I'd like to imagine, and having these conversations, but still early days, going in. Irving, I don't know, maybe, you have a view about if you're going and talking about private equity funds or venture to clients, what do they want? What do they think they want? Because that's what they think they want.
Well, I think it's so adding the impact investing lens to the dynamic makes a huge difference, because it's, you're going back to the motivations for why someone is doing what they're doing in terms of this investment activity, right? When it's purely VC or purely private equity, there is, the investor greed, which is, I want the shortest time horizon possible, I want the largest return possible, the largest multiple, the largest IRR, and there's no questions asked about it.
No
exactly,
risk.
With the lowest risk, no currency risk, none of that. I'm not willing to accept anything. Be I think this is where, I feel that, in the impact investing space, this can be a very meaningful way to be meaningful route to raising capital, because the motivations aren't purely financial. Yes, they are financial, but, the financial and emotional and do-good appeal, they almost hold equal seats at the table. So for, someone maybe resident in West Africa looking to access idea flow or, be part of a dialogue in East Africa, let's say, this is a channel that we can provide them, which may not have, naturally been open to them previously. So that's the dialogue that we're promoting, the relationships we're promoting to build, and then hopefully off the back of that, at a later stage, get it to something more meaningful in terms of being willing to commit for a 16-year period, or, take a realistic time horizon on currency moves, So I think that's where we're trying to go. But I think that the success rate with the impact investing lens for VC or private equity in Africa specifically will be much more successful than any other route, because it is the only meaningful way to access ideas in Africa that could be meaningful over the long term. And we have the advantage of having an Africa-based client base who understands maybe you can't put a blanket approach across the whole continent, but there are some common themes, and a lot of our investors would understand that from having built their own wealth in Africa. So I think the impact investing lens is important.